So you're looking to outperform the market, huh?
Yeah, always a good goal.
And these high-yield dividends have caught your eye.
Smart move, especially with all the uncertainty around Fed rate cuts.
But before you jump in,
Right.
let's equip you with the insights you need
Okay.
to make a truly informed choice.
Yeah.
We'll be diving deep into two companies
Okay.
making waves.
Right.
Pfizer, the pharma giant,
Mm-hmm.
and Philip Morris International, the tobacco company.
Interesting.
One's grappling with challenges,
Mm-hmm.
while the other is reinventing itself.
Okay.
To help you decide which one might be right for you,
Yeah.
we need to understand if those dividends are truly reliable.
That's the key.
Can they keep paying out?
Yeah.
Or are they just dangling a carrot?
That's the crucial question.
To figure that out,
Yeah.
we'll be looking at some key factors.
Okay.
The payout ratio,
Mm-hmm.
which tells us how much of their earnings they're shelling out in dividends,
Right.
their debt levels,
Mm.
because a company drowning in debt might struggle to keep those payments flowing,
Exactly.
and of course, the overall health of their business and industry.
Mm-hmm.
Are they in a growing market or one that's fading away?
That's the big question.
Okay, so let's unpack Pfizer.
Right.
They're offering a whopping 6.77% dividend yield,
Wow.
which sounds incredible.
It does.
But their stock is down this year.
Huh?
So is this a chance to buy low
Mm-hmm.
or a sign that something's amiss?
Well, Wall Street seems to have some doubts.
Oh, really?
Yeah, they haven't been thrilled with Pfizer's recent acquisition spree.
Okay.
Some of those deals just haven't lived up to the hype.
Yeah, like that whole situation with Oxbrita,
Mhm.
their sickle cell drug.
Right.
They had to pull it off the
Can
market
you remember that?
after acquiring Global Blood Therapeutics.
Yeah,
Not exactly a win for them.
right. And that makes investors nervous,
Okay.
especially with potential political changes on the horizon. There's concern about how the incoming administration might approach drug and vaccine approvals.
I see.
Some worry it could mean tougher times for companies like Pfizer.
So some definite storm clouds on the horizon.
Yeah,
But Pfizer's making some strategic moves too, right?
absolutely.
What about their big push into oncology?
Their oncology division is actually a bright spot,
Okay.
driving significant growth.
Oh, wow.
They're doubling down on that strategy
Mm-hmm.
with their acquisition of Seagen,
Oh, right.
which gives them access to a promising pipeline of cancer therapies.
But even with the challenges, they're not standing still.
Right.
They're trying to adapt and evolve.
Exactly.
And their shares are currently creating near historic lows.
Mm-hmm.
That has to be tempting for bargain hunters.
It's definitely something to consider.
Okay.
But remember,
Yeah.
that high dividend yield
Right.
is partly because the price has dropped.
Okay.
We need to understand if that drop is justified or if this is a true buying opportunity.
Okay, let's switch gears
Okay.
to Philip Morris International.
All right.
They've got a completely different story.
Interesting.
Their stock is up over 36% this year,
Wow.
but they're still offering a decent dividend yield,
Mhm.
around 4.2%.
Okay.
How are they managing that?
What's fascinating here is their proactive transformation.
Mm-hmm.
They're moving away from traditional cigarettes
Right.
and going all in on smoke-free products.
Right, their IQS device.
Yeah.
The one that heats tobacco instead of burning it.
Mm-hmm.
But is that really driving results?
It's bringing in serious revenue.
Oh, wow.
Almost 40% of their revenue now
Really?
comes from smoke-free products.
That's impressive.
They're not just talking the talk.
Hmm.
They're walking the walk.
Okay.
They also recently acquired Swedish Match,
Oh, right.
adding Zyn nicotine pouches to their portfolio.
Okay.
Another fast-growing smoke-free product.
Wow, 40%.
Yeah,
That's a huge shift.
it is.
And it sounds like they're putting their money where their mouth is.
Exactly.
They're not just talking about change,
Mhm.
they're making it happen.
Right.
But what does that mean for their dividend?
Yeah, that's a good question.
Can they really keep it up
Uh-huh.
while making such a big transition?
That's where it gets really interesting.
Okay.
Here's a surprising fact.
All right.
Their smoke-free products
Mm-hmm.
are already bringing in more revenue
Oh, wow.
per unit
Okay.
than traditional cigarettes.
So they're actually making more money from these alternatives.
It seems that way.
That changes things.
It does.
And it makes their dividend
Yeah,
look much safer in the long run.
right, because they're
Yeah.
not clinging to a dying industry.
Mm-hmm.
They're leading the charge into a new one.
And they've set a pretty ambitious goal,
Yeah.
aiming for 2/3 of their revenue to come from smoke-free products by 2030.
Okay.
Do you
Yeah.
think they can pull it off?
Their current progress suggests it's achievable. They're not just reacting to market changes.
Mm-hmm.
They're anticipating them.
Right.
And that's a key indicator
Okay.
of a company that can likely sustain its dividend.
So we've got two very different companies here.
We do.
Pfizer, the giant with the massive dividend,
Mm-hmm.
but also some big question marks.
Right.
And then Philip Morris,
Yeah.
the company making a radical transformation
Yeah.
and seeing real success.
Right.
But which one aligns better with your goals?
To figure that out, we need to dig deeper
Okay.
into those key factors we talked about.
Mm-hmm.
Payout ratios, debt levels, and those all-important growth prospects.
Oh, okay.
Let's see how these companies stack up.
All right. So we've got these two companies,
Yeah.
both offering enticing yields,
Mm-hmm.
but for very different reasons.
Right.
One's a classic giant
Yeah.
trying to navigate a changing landscape.
Uh-huh.
The other's boldly jumping into a whole new market
Okay.
to help you decide which approach aligns with your goals. Let's take a closer look at those key factors
Okay.
that can make or break a dividend.
All right, let's start with the payout ratio.
Okay.
This tells you what percentage of a company's earnings is being paid out as dividends.
Okay.
It's like a stress test for their generosity.
Okay.
A high payout ratio can be a red flag.
Oh, really?
Imagine you're spending most of your income every month,
Mm-hmm.
leaving little room for savings or unexpected expenses.
So a high payout ratio for a company
Yeah.
means they might not have enough left over
Exactly.
to invest in future growth
Mm-hmm.
or handle unexpected bumps in the road.
Yeah, exactly. They could be forced to cut the dividend down the line,
Oh.
which would be bad news for investors
Right.
who are relying on that income.
Okay.
Now, when we look at Pfizer,
Yeah.
their payout ratio is currently pretty high.
Oh.
It's something to keep an eye on.
Okay, so high payout ratio,
Yeah,
potential for instability.
right.
What about debt?
Debt is like a weight around a company's angles.
Mm-hmm.
It can drag them down,
Okay.
especially if interest rates rise.
Right.
Remember those potential Fed rate cuts we talked about?
Yeah.
Well, if those don't materialize
Okay.
and rates start climbing,
Mm-hmm.
companies with heavy debt burdens could really feel the squeeze.
It's like having a mortgage with a variable interest rate.
Exactly.
If rates go up,
Yeah.
you're suddenly paying a lot more every month,
Mm-hmm.
and that can put a strain on your finances.
Right.
So how does Pfizer look in terms of debt?
They do have a significant amount of debt.
Okay.
It's not crippling,
Okay.
but it's something to consider,
Hmm.
especially when coupled with that high payout ratio.
Okay.
It's not a deal breaker,
Okay.
but it does add a layer of risk.
Okay. High payout ratio, significant debt.
Yeah,
Not exactly a glowing report card,
sure.
but they are making moves
Mm.
in that oncology space.
Right.
Their oncology division is growing, and their acquisition of Segan
Right.
gives them access to some very promising therapies.
But those therapies are still in the pipeline.
Oh, okay.
It's not guaranteed revenue.
Right. Yes.
So while it's a potential bright spot,
Yeah.
it's not a sure thing.
So we need to weigh the potential rewards
Mm-hmm.
against the risks.
Yeah,
High yield, potential instability.
right.
Let's see how Philip Morris compares.
Now, Philip Morris
Mhm.
has a lower payout ratio and less debt.
Okay.
They're in a better position financially.
Mm-hmm.
But remember,
Yeah.
they're making a huge transition away from their core product.
Right.
That's not an easy feat.
Right. Even though their smoke-free products are doing well,
Yeah.
it's still a gamble.
Sure.
The market for those products could shift.
Mm-hmm.
Consumer preferences could change.
Yeah.
Regulations could tighten.
Right.
There's always uncertainty when you're disrupting an industry.
Absolutely.
But here's what makes Philip Morris interesting. They're not just reacting to a shrinking market for cigarettes.
Mm-hmm.
They're actively shaping a new market.
Right.
And they're doing it with products
Yeah.
that are already more profitable
Mhm.
than their traditional offerings.
Right.
That's a powerful combination.
It is?
It's like they saw the writing on the wall
Mm-hmm.
and decided to build a new wall with a better view.
I like that.
But is that enough
Yeah.
to make their dividends safe in the long run?
Here's where their track record comes in.
Okay.
They've consistently paid dividends for years.
Mm-hmm.
And their transition to smoke-free products
Mm-hmm.
is not just talk.
Okay.
It's backed by substantial investments
Okay.
and concrete results.
Mm-hmm.
They're not just throwing spaghetti at the wall to see what sticks.
Right.
They've got a plan,
Okay.
and they're executing it.
So their lower payout ratio,
Yeah.
their lower debt,
Mm.
and their proactive approach to a changing market
Right.
all point to a potentially more stable dividend. It's exactly.
It's not a guarantee, of course.
Of course not.
No investment is.
Right.
But they've positioned themselves well.
Yeah, they have.
They're not just riding the waves. They're learning to surf.
That's a good analogy.
Okay, so we've got two very different dividend stories.
We do.
One with higher yield,
Yeah.
but more uncertainty.
Right.
The other with a more modest yield, but seemingly stronger fundamentals.
Exactly.
It's like choosing between a stock that's a roller coaster and one that's more of a steady climb.
I see.
Which one's right for you?
Yeah, that's the question.
Depends on your risk tolerance, your investment timeline,
Right.
and your overall financial goals.
Exactly. There's no right or wrong answer.
Okay.
It's about understanding the trade-offs and making an informed decision based on your individual circumstances.
So we've unpacked the payout ratios, scrutinized the debt levels, and explored those all-important growth prospects.
Right. Now let's get practical.
Okay.
How can you use these insights to make smarter choices for your own portfolio?
It's all about finding that sweet spot between risk and reward.
Mm-hmm.
And that sweet spot looks different for everyone.
Right.
Someone in their 30s saving for retirement has a much longer runway than someone nearing retirement who needs to generate income today.
Right. Time horizon is key.
Yeah.
It's like planning a road trip. If you've got months to meander,
Yeah.
you can take the scenic route, explore those back roads.
Right.
But if you need to get somewhere fast, you're sticking to the highway.
Exactly.
And when it comes to high-yield dividends,
Yeah.
you need to choose your route carefully.
Mm-hmm.
Are you comfortable with a bumpier ride
Okay.
for the chance of a bigger payoff? Or do you prefer a smoother journey,
Yeah.
even if it means a slightly slower pace?
That's the question.
Let's say you're that younger investor with time on your side.
Okay.
You might be willing to take on more risk for the potential of higher returns.
Yeah.
Pfizer with its high yield and its ambitious moves in oncology
Right.
might seem tempting,
It might.
but you need to be prepared for some bumps along the way. Their turnaround isn't guaranteed,
Right.
and their high payout ratio and debt levels add a layer of uncertainty.
True.
But if you're closer to retirement
Okay.
and looking for more stability, Philip Morris with its lower payout ratio, lower debt,
Right.
and successful transition to smoke-free products might be a better fit.
Possibly. Yeah.
Their yield is lower, but their path seems more predictable.
Yeah.
They're like that reliable car, you know, will get you where you need to go.
Right.
It's like choosing between a flashy sports car and a sturdy SUV.
Okay.
Both can get you there, but the ride will be very different.
Exactly.
The key is to understand your own needs and preferences.
Absolutely.
And remember, diversification is your friend.
Oh, yeah, that's key.
Don't put all your eggs in one basket.
Right.
Even if that basket is a high-yielding one, spread your investments across different companies, different industries, and even different asset classes.
Exactly.
That way, even if one investment hits a rough patch, the others can help cushion the blow.
It's like having a safety net under your high wire act.
Right.
You could be bold and daring,
Yeah.
but you still want that net there just in case.
And speaking of safety nets, here's a final thought.
Okay.
High-yield dividends can be tempting,
Yeah.
but they're not a substitute for thorough research.
Right.
Don't just chase the highest yield you can find. Dig into those company financials, understand their business model, and make sure their dividend is sustainable.
Exactly.
It's like admiring a beautiful house. Okay.
You love the curb appeal, but you wouldn't buy it without inspecting the foundation, the plumbing, the wiring.
Right.
You need to know what's supporting that beautiful exterior.
Exactly.
And that's what these deep dives are all about.
Yeah.
Equipping you with the knowledge and tools to make informed decisions.
Right.
So you can invest with confidence.
Yeah.
Not just hope.
Beautifully said.
This has been such an enlightening journey. We've gone beyond the headlines, explored the nuances, and uncovered the stories behind those tempting yields.
I hope we've empowered you to make smarter choices for your own financial future. Remember, investing is a marathon, not a sprint.
Right.
Stay curious, stay informed, and never stop learning.
Wise words to live by.
Thanks for having me.
Thanks for joining us for another deep dive.
Yeah, it was fun.
We'll see you next week with a brand new topic and a fresh set of insights.
Sounds good. Until then, happy investing.